Well, it was another busy week in the financial markets last week. US inflation coming in a little bit cooler than expected at the headline level, but core inflation remaining sticky, which will concern policymakers over at the Fed. Speaking of policy, the Bank of England raising rates by 25 basis points last week, as everyone expected. In terms of the markets, the dollar starting to find its feet a little bit more, despite both equities and treasuries remaining largely range-bound. Let's see whether that momentum can continue into the new trading week. And let's get into all the hot topics driving markets in this week's trade-off. Well, as I said, it was a busy week last week. I'm sure another busy week awaits this week. It's good news out there for the dollar bulls, and it's bad news out there for us Arsenal fans, given that we threw the league title away once and for all this weekend. Ryan, we were chatting just now, Ryan Littlestone from Forex Flow Live and Forex Analytics. Welcome to the show. We were chatting just now. It's not often that your team, West Ham, have better fortunes than Arsenal, but so it would seem at the moment.
Yeah, you seem to have blown it. We blew it, funny enough, against us, if I recall. So, I don't want to say we were the downfall, but we were the downfall for you lot, and long may it continue.
You most certainly were, and I was really hoping you wouldn't mention that. So before you can get any other football digs in, let's get into topical thunder. So I want to talk about US inflation, first of all. That was probably the key event risk of last week. Headline CPI, as I said in the intro to the show, coming in a little bit softer than expected at 4.9% on a year-on-year basis. The core number coming in a little bit lower as well, but also remaining pretty sticky at 5.5%, year on year. I think the really interesting thing when you look at inflation, and I know you want to get into this yourself in a moment, is this divergence we're seeing between services and goods. And this is something we see in terms of activity, of course, where expansion or the pace of expansion in industry is a lot slower, or even we're seeing contraction compared to the services sector. And it's something similar we're seeing in inflation as well. Services prices remaining elevated and price pressures there remaining intense, even as factory gate inflation starts to roll over. The PPI number coming in quite substantially below expectations last week, which is a promising sign on that front. And I think that's what's feeding into this idea that inflation expectations now, of course, consumers aren't exactly great at gauging where inflation is going to go, but we need to look at inflation expectation numbers. The University of Michigan survey that we got out on Friday afternoon, 5-year inflation expectations at their highest level since 2011. And I think that's likely to concern the Fed. And when you think about that in the context of this big debate that's going on in the markets at the moment around who's got it right on monetary policy in the second half of the year, is it the Fed, who are saying they're going to stay where they are and they're going to stay the course and they don't envision cutting rates? Or is it the market, which continues to price around 70 basis points worth of cuts this year? And I think, for me, that is the hot topic at the moment, and certainly into the second half of the year, is or indeed when, does the market stop fighting the Fed?
Good question. When you know that answer, let me know, please.
Answers on a postcard, please.
Yeah, exactly. But you're right, and I think this is what we're going to see. It's going to be a bit of a mess. Nothing's going to go in a straight line, and I think what it's going to come down to, where does inflation settle? It's not a question of where going in one way, coming down another way. Are we ever going to go back to 2% inflation? It's possible, but I don't think we're going to stick there. I don't think we're going to go below 2% and back to zero or anything like that, or even into negative. But we might see that on a lot of the monthly numbers. But in general, we're not going back to price levels that we saw 2-3 years ago before COVID, that sort of thing, because inflation is always there. That's why houses, when my parents bought houses, they were in the 4-figure numbers. Now they're in the 6-figure numbers. It just doesn't happen. But how we get there trading wise is going to be the big question. Which economies are going to be more sticky than others? I can see the US continuing to drop in inflation. How far it goes, I don't know. And those expectations, you're right to point out, the 1 year dropped by a pip, but like you say, the 5-year inflation went up by 2 pips. So the expectations from the market, and this is where central banks really get taught up about it, is those inflation expectations becoming entrenched in the market. Because once it does that, once it becomes entrenched on the ground level, you don't see prices going down.
No, exactly. It's almost like toothpaste coming out of a tube. It's very, very easy for toothpaste to come out, but good luck trying to get that back in once it's come out. And that's exactly what central banks are trying to do in terms of re-anchoring inflation and inflation expectations at their 2% target. And we've got a ridiculously busy week of central bank speakers this week. I think we've got Powell on Friday, Bailey on Thursday, Lagarde is speaking a few times in the mix as well. So yeah, certainly watching very, very closely to see if they make any comments on that front. But what about CPI elsewhere? Because I know you want to get onto that.
Yeah, well, it's obviously the hot topic, and particularly for Japan, and we get their next reading of CPI on Friday. Again, inflation is expected to carry on climbing there, whereas it's completely opposite in a lot of other countries. So expected to headline CPI to go to 3.5% from 3.2% currently, and that all-important core number expected up 3 pips to 3.4% as well. So it's staying high above the Bank of Japan's 2% target. Going to keep the BOJ edging towards the exit door. And already USDCNH has been leaning more towards what happens with getting out of this easy policy than staying in it and continuing. You know, that's the conversation we're getting now from Japan. You know, it was noted last week that there's been a bit of a language change from him, where it's no longer persistent easing, but it's patient easing. And all these little subtle changes are adding up now. It is going to be a slow-moving process, as we've been speaking about on many shows here. You know, they're not going to turn around next month and say, right, we're going to hike rates 50 pips, nothing like that. But if this turn is real, if inflation remains elevated, then maybe after decades we are going to see the end of easy policy in Japan. And there's probably a few traders among us who doesn't know what life was like before then. You know, I would say you, Michael, you're a bit of a youngster, but I think you can just about remember that.
Just about. I'm sure you certainly can without giving any secrets away. But yeah, you're absolutely right. It makes me think back to what we were saying actually a few weeks ago after the last Bank of Japan meeting, where I think we both sat here and said two things. One is that the market had probably read into the wrong part of the BOJ statement. I think at the time the market was very focused on the fact that the policy review is going to take 12 to 18 months and almost going, well, they're not going to do anything in that time period. Of course, we've seen since, and you rightly say the commentary since has been very much a case of we don't necessarily need to wait for this review to be over before we alter our policy. And the other thing that we made mention of, and I think it was you actually that made the point at the time, Ryan, was it is going to be these very subtle, very minor changes to the language that we need to pay attention to as the first signals that the BOJ are looking to finally come out of this decades-long era of ultra-loose policy. And we're getting that at the moment. It's just starting to make me think, I mean, the yen has been trading pretty much in line with treasuries. It's been softening a little bit of late. And it's just starting to make me think whether actually we could get a bit of a hawkish surprise out of the BOJ at their next meeting later next month. Sorry.
Yeah, absolutely. And you know, even just further language changes towards exit is going to be pretty big for the yen. And I think if we didn't have this debt ceiling stuff going on in the US, I think you know, dollar yen and yen pairs in general will be much lower. So you know, it's really a mixed bag, and I think we're heading for a surprise. I don't think we're going to see us down at 100 or anything like that, but certainly if they do start tightening significantly and properly and acknowledge that inflation's here to stay, then I would expect you know, dollar yen to maybe move down into that 120s. But we've also got some other data this week. You know, this week is the start of US manufacturing week. We get the Empire State, which we've just had out as we do this recording. Another shocking number, minus 31.8, I think it was, versus minus 3.75. And, you know, some of the subcomponents not looking too hot as well. So we've got this flip-flop between, you know, the data. And once again, as you said, the divergence between services and manufacturing. We get the Philly Fed later on, and we'll monitor this data for obviously the price and job components and their implications for the central banks.
Absolutely. Central banks. Let's get on to our favourite. The Bank of England. What an absolute shambles. We talk about flip-flopping. It's not going to 5%. That's still punchy. What did the BOE do last week? They raised rates by 25 basis points, as we expected. They voted 7-2 to do that, as expected. Dinger and Tenreiro still voting for policy to remain unchanged, being utter morons, as we also expected. But I think actually the BOE's economic commentary is really what interests me out of last week. They start with their tightening bias, saying that if there are signs that inflation is becoming persistent, then they will raise rates further. And I think we all know, having lived through it, and we refer back to those inflation expectations we were mentioning earlier, I think it's pretty clear that they are going to have to go one more time, in my view. I pray to God they don't go two more times, because it's going to ruin my reputation on this show. But I think one of the comments the BOE made, which was really interesting, particularly in the context of what we've got coming up this week, was around wage growth. Because the BOE actually said that there is a risk that earnings growth will stabilise at a level that is incompatible with a return to the 2% target. And I thought that was really interesting, because we've had months now of earnings growth in the UK around or just above the 6% mark. And of course, this is before all of the industrial action that's come through as well. You've got doctors on strike, railways are on strike, nurses are on strike. I think the postal service are on strike. It's easier to list who is working at this point, to be quite honest, here in the UK. And I think you've got to consider the impact of those wage settlements coming into the data as well. So it's no surprise the BOE saying the risks to the outlook are skewed to the upside. They've also abandoned their recession call for this year, which on its own is a pretty good sign, and we should take some solace in that. But I still just can't get myself to be bullish on the pound. We obviously saw sterling have a poor week last week. We came back below 125 when you look at cable. But there's still just this nagging thought in my mind, and the GDP data we got on Friday, with the economy contracting 0.3% on a monthly basis in March. There's just this nagging thought in my mind that the BOE's optimism might end up being misplaced. They are hiking and tightening into a slowdown, and the UK is dealing with stagflation, and I just can't bring myself to be bullish on the pound in that sort of environment.
Yeah, it was pretty amazing announcement, really, because we looked at it and it dropped, and it was like, wow, this is hawkish, this is bullish, this is hawkish. The pound should fly from here. And I jumped into cable as fast as my finger could hit the button. I think at 126.07, which ended up being about 10 pips off the high in the end, because what I'm now going to call the Bailey Bosch worked its magic, where whenever he speaks, the pound dumps. And that's what happened in the presser and afterwards. But yeah, very bullish, and a complete flip around. They flipped their forecasts, economic forecasts, by 75, 50 points. We're not talking about us, the UK, booming. I think their forecast for this year went from minus 0.5% or 0.25% to plus 0.75%, so not even a 1% gain this year. But yeah, it was pretty hawkish, if you like. And you think they've got one in the pipe. I think they've got probably two in the pipe. And if that happens, you're going to see a little something appear in my backdrop next time. 5% mark, something that oinks. You'll remember that from conversations with Blake. But the big take from the meeting was that we've had yet another central bank following the Fed, following the ECB, where a currency has been very buoyant into it, and straight after, bang, it's taken a big whack, and now we're looking like things are going to be heading lower rather than higher for the pound and particularly cable.
Yeah, absolutely. Just before we get on to your final segment, I just want to justify why I don't think the BOE will get to 5%, because I know this has become almost a running joke at this point. The way the BOE signal their future policy is ludicrous. And I came in for some stick for this on the other show that we do, Trading Blokes, last week, where I said, actually, the dot plot that the Fed produces hapless and hopeless. But it would be better if the BOE did one than what they actually do, which is they signal policy and they signal their view on where the market thinks policy is going based on the 2-year ahead CPI forecast using the market rate path as an input. Now, that's a mouthful to say. It's even more complicated to explain. But the note I'm getting at here is the BOE did their forecasts. The market expected the terminal rate to get to around 4.9%. I think it may have been a couple of basis points shy of that. And 2 years from now, the BOE see inflation at 1.1%. And what the MPC are saying with that forecast, now, obviously their forecasts have been hopelessly wrong over the last couple of years, but what the MPC are saying with that forecast is, based on what the market thinks we'll do in terms of tightening, we would tighten too much and inflation would fall too far below target, which is why I don't think they get to 5%, just to justify that point. But let's get on to your final topic.
I don't care how you try and justify it, Mike. It's going to 5%. And if it's 5%, I'm ringing the bell, and then you can do what you like after that. But if we do get to 5%, I think we're at the end. And, that's what I'm talking about in this bit. We are at the end of the hike cycle, potentially. The market is giving us plenty of clues. As mentioned, 3 central banks, 3 times the currency has fallen afterwards. The market is shifting, a big shift between hike and hold to now hike and cuts. And that's what we're going to be playing for the next few months. There may be some surprises, as we know from the RBA. They went on pause, and then next month they hike again because they're not quite ready to really go on pause, and the data's not playing ball. So there's going to be a few wobbles like that along the way. RBNZ, another one as well. But I think we're definitely shifting into that next phase of monetary policy. I mean, the question I wanted to ask you is, what happens if there are inflation surprises? Let's say we do get to 5% for the Bank of England rate, and the Fed get to their ceiling, but inflation picks up. Are we going to be seeing rates going to 6%? In the Fed, 6% in the UK, maybe 5.5 for the ECB. What is the market going to do with that? And are we going to see hawkish currencies?
I think this is where you get a real problem because, as you said, central banks are coming to the end of their tightening cycle. They're going on pause, but all these pauses are conditional. And as we saw with the Reserve Bank of Australia, it was very much a case of, it was conditional and it was a pause for about 4 weeks. And then they were back caring about inflation once more. I hope there's no Aussies watching this who take offence at what I'm about to say, but the RBA is small enough and insignificant enough in the global scheme of things that they can do that and get away with it. It's going to impact the Aussie dollar. It might impact the Aussie housing market, but it's not a global financial market event. We're not going to see the S&P move based on what the RBA do. If it's the Fed, if it's the ECB, if it's the BOE, it's a different story because those central banks are big enough that they have a broader impact on markets that are not just their domestic market. And I think the key determinant of whether they pause and are then able to hike again is what happens with growth and what happens with the labour market. If the labour market is still resilient and if growth is holding up and inflation ticks higher again, then I think Powell certainly would have no qualms with raising rates again, probably after the summer. And I think also you've got to remember the financial stability issues that we're seeing in the US as well. Lagarde similar, Bailey similar. But if we're in an environment where inflation steadies and then picks up again, particularly the core number, but at the same time of that, the labour market finally starts to roll over and we see growth softening, that's when central banks have got a real dilemma. That's when they go, do we tighten and make the slowdown that we're seeing in growth worse and make the pain in the labour market worse? Or do we do nothing and make the pain on inflation worse? And in that position, I would not want to be a central banker, no matter how much anyone was prepared to pay me. But I think it's a very, very interesting one. And I think the FX market in particular will probably end up rewarding currencies where rate hikes happen based on a resilient economy and punishing currencies where rate hikes happen again but make the economic situation in terms of growth, in terms of jobs, significantly worse. That's just my 2 pence worth anyway.
Yeah, and that 2 pence is probably worth about 10 pence. It's very good, very good analysis there.
Well, we were talking about inflation. There you go. There's 5 times inflation just in the space of about 10 seconds. With that said, let's get into some charts. So I want to talk about the dollar first of all. I've just seen in the sidebar US 1 month bonds, and it means we're going to have to talk about the debt ceiling, doesn't it?
Yes.
I thought I'd banned it from this show, but clearly not. In any case, the dollar, it's doing well. The dollar's rebounded a little bit. And actually, the dollar index last week had its best week of the year and its best week since last September, which is very, very impressive indeed. For a technical basis, we closed north of the 50-day moving average for the first time since the middle of March. And it now looks like we're targeting around this 103 level, which is important. It's not just a big figure, which is obviously important from a psychological standpoint, but we've also got the 100-day moving average lurking here as well, which, as you can see by the chart, we certainly haven't been above in the last 5 or 6 months. I think it was actually the third quarter of last year when we were last trading north of that important green moving average. If we can get a closing break here, then it does look like the dollar has further room to run to the upside. I think a big driver of what we've seen so far has been concerns in terms of global growth. We do seem to have had a little bit of more pessimism come back into the market over the last week and a half, and that's helped us move towards the left-hand side of the dollar smile a little bit. And of course, breaking the 50-day moving average may have flushed a few of the weaker shorts out as well. So I think if we do get above that 103 level, we might rally a little bit more, perhaps up towards the 104 or 105 mark. But I certainly don't think we're going to see any rapid or sizable pickup in FX volatility at the moment. I think the real upside risk to the dollar is if the market wakes up and smells the coffee and starts to price out those cuts it's got in the curve for the back end of the year. But as far as I see it, I don't think that's going to happen anytime soon, Ryan. What are you thinking here?
Yeah, I mean, DXY I'm not a fan of DXY because it's hard to trade and it's pretty much all the euro anyway. But it has been in a range, and that's been indicative of what we've seen in FX. You can call this a 180 as you've got there, and up to 103s, and the 102s has been a bit of a level as well. So yeah, it's indicative of a lot of FX pairs is that we're seeing ranges, and we've got some decent movement between those ranges, but we're not breaking any new ground. I mean, the euro's obviously looking a bit sucky as we come into this week, but we're not breaking any of the trend levels. We're not breaking some of the fibs that are in play. So I don't see anything breaking as far as dollar strength is concerned, but it doesn't take much to change that. I think the debt resolution, should we get one, that's something that will cause a bit of a US risk on, if you like. But other than that, yeah, I think we're ranging. So I'm not going to get too excited about something like the Dixie breaking.
No, I think it's tough to get excited about anything in the markets at the moment, such as the sort of subdued conditions that we see. What's going on in dollar China? I know we seem to look at this one every week at this point.
Yeah, well, it is a regular, and the reason it's a regular is because I'm trading it regularly, and I've been in a trade for several weeks now. So I think it's important that when you do analysis, when you highlight pairs to trade, that you also stick with it and give a commentary to help traders along, so you can get some of the thought process. Because it's all right to say, yeah, I'm buying this and I'm going to take profit there, but it's what you do in between. When the price moves and then it stops, do you take profit? Do you hold? Do you cut? And so I think it's important to look at trades as they develop, just to give some insight, as I say, to the thought process there. But looking at this one, yeah, this is one I've been long. I was looking at the break above the 91 handle. We got that. It's held. So technically, it's playing very nicely. We've had a move up to the next area, those two fibs. One's an old fib, one's a new fib. We're above those. We're now holding above another level around about 95. So it's looking very constructive for this pair. And then we have the big 7 level up above. So for my longs, I'm looking while this holds this 95 for the move to build and move to that 7 level. Once we get there, I'm going to be looking to take some further profit. As it's such a big level, and you can see it from the chart there, I'm in two minds whether just to take some profit and get into a separate short and maybe then reload on a dip, or to get out the whole trade in its entirety and maybe look at a short just on a first test to that level, just to see what the market wants to do. But we also got to be careful if we get to that 7 level, whether we get some official talk out of China as to whether they're going to allow this move to continue, or whether they might put the brakes on it. And if they do, I'll be getting out as fast as I can hit the machine.
Yeah, I'm glad you said that, because that surprised me that we haven't heard any kind of official rhetoric or talk on that front just yet. And I think as we get closer and closer to 7, the chances of that, just from a psychological point of view, that the chances of that get higher and higher and higher. And I think you're absolutely right. As all the time the Chinese authorities are saying nothing, it's implicit contentness with the move that we see. If they come out and say something, the trend changes, get out of Dodge as quick as you can.
Yeah, exactly. And they're very good. That's why I like trading this company. They are very good at signalling when moves are over, when they've had enough of a one-way move, if you like.
They're also very good at rigging economic data. We've got plenty of that coming out this week, but that's probably got me on some blacklist for never going.
Another show. That's really.
It is indeed. Let's look at the Aussie dollar. This was wasn't buy play of the day because we wouldn't have actually got into it. I said we would buy a closing break of the 68 handle after the hawkish surprise that we got from the Reserve Bank of Australia. You can see from the chart there, we had a few intraday breaks of 68, but we didn't get it on a closing basis. And it seems that and the 100-day moving average are capping the Aussie dollar's gains there at the moment. And we've obviously seen price come back into the middle of what is now a very, very long-standing range, going back to, the start of March this, or perhaps even longer than that, between around 64 and 68 on the Aussie dollar. I think there's arguments both ways here. I mean, on the bullish side, you could say risk assets are holding up relatively well, particularly when you look at tech stocks. The RBA remain hawkish. The Aussie dollar should rally. And then on the bearish list, you've got the fact that China does appear to be slowing down. We've got a lot of activity data coming out there as well. And of course, the technical factor that we couldn't force our way through that level last week. And you then start to question what the impetus would be to get us above that. But I think for me, this really just epitomizes the FX space at the moment, perhaps better than that dollar index chart, where the theme for months now has been we get to a long-standing level, we try and break it, we get a bit of a party going, we think we're going to get through it, and then about an hour or a day later, the market takes us all away from us once more and takes us back into the range that we've been trading for quite some time. And I think for me, it's a game of patience. It's wait for one of these levels to break on a closing basis, and that's when you can then enter the trade, and that's when we might get a little bit more of a trend going. But for now, whether it's the Aussie, whether it's cable, whether it's euro dollar, I think it really is a waiting game, the FX space.
Yeah, well, I'm not going to be rude and say I used that play last week as a bit of a contraindicator, but I did short 68 last week, and I'm still in some.
I'm glad I have my uses, mate.
Yeah, it was good analysis. As you said, you need that break, you need that close above the level. For me, this is a perfect example of ranging, as we've been talking about. We've got that lows down into the 68, 80s. And we've got these highs into the 68s, and while they hold, you can trade between these levels. Dollar CAD we've spoken about previously. That was another one, 133, big level. It's held several times now. So if it doesn't matter what you want to do in the middle. If you're a short-term trader, you can scalp away. But if you want to have a little bit of patience, wait for these levels to hit, wait for them to hold, then they're giving you enough opportunities. I mean, what we've got there, 5, 6 attempts at breaking that, and we can't. That's 5 good attempts at trades that have brought decent profits if you got in them. And look for that break. If it confirms, then it's time to switch it. I think we may be going somewhere new, and you don't have to trade it with any wide stops on it. If you're back under that level really quickly and it's looking like a fake out, well, you can get out for 20, 30 pips, no harm done, and see what happens next.
Yeah, absolutely. Right. Go on then. I'm going to go and cry in the corner from boredom while you talk about the debt ceiling.
Well, you've got to talk about what's relevant. And, we've got these debt talks coming up. And as we do this show, we've had some positive comments over the weekend from Yellen, from Brainard, who's moved now to the government, about how talks have been constructive. Yellen saying there's some optimism there. Even Biden saying there's some optimism. We've got talks tomorrow, probably after this show has aired. Are we going to get a decent resolution? And I'm highlighting one area where you can see the effect of these debt talks in play. And this is the 1 month US bonds. And as you can see there, we're sailing well above where the Fed funds rate are at the moment. It gapped up higher last week because there was we call it a poor auction, if you like, because the yield on that absolutely rocketed. And that's indicative of investors showing where they see the risk. No one wants to be holding or buying 1 month bonds unless they're going to get a premium for it right over June, when this debt stuff is potentially going to blow up. And we've seen that in the markets where they're getting out of investors are moving out of shorter term paper into longer term paper. So we've seen this yield rally. We've seen other longer term, 5 years, 2 years, 10 years, 30 years, all the yields pretty much dropping as investors move their money to that longer term. And I think this is one where you're going to need to watch carefully, because there's 2 possible outcomes for this. If we get a short-term can kick, let's say they punt it to September, I don't think the market's going to like that an awful lot. We may get a small relief rally, but it's just delaying than the inevitable for a couple of months through summer, so everyone can have their holidays. But if we get a proper punt to 1-2 years down the line, the market's going to go, right, thank you very much. This is this episode over for another couple of years, and we'll worry about it in 2 years' time. And we'll get a bigger risk reaction or asset positive reaction in the US, stocks, dollar, yields, so on and so forth. And we'll get a switch out of these 1 months, and we'll see those yields coming down, and we're likely to see the other yields benefiting as well. So this is the one to look for those debt situation, and hopefully next week we'll talk about resolution, or Mike's going to pop a stack.
Well, hopefully next week we can talk about something else. Yeah, I mean, you just use my chart as a contrarian indicator, so I can say this. I've got absolutely no interest whatsoever in the front end of the Treasury curve or in the debt ceiling talks. It's going to get resolved. We all know it's going to get resolved. In fact, the only interest I have in it is if we see any moves that you can explicitly pin on default concerns or similar, or US running out of money worries, I'll fade them all day long, because we all know this one gets sorted out. It's just a question of when and how much political pantomime we have to endure in the meantime. But then again, we did have about 5 or 6 years of Brexit negotiations. So we're quite used to political pantomime, Ryan and I. So we should be able to take this one in our stride. Let's get on to our plays of the day. So I'll look at the Nasdaq this week. Oh, we've got 2 equity plays. That's an interesting one. Let's see if we're both on the same side of things. The tech space is continuing to lead the market higher. I shared on self-promotion, I shared on Twitter this morning a relative rotation graph. I don't know whether viewers will have seen one before, but it effectively plots how various sectors have been performing over the last 12 or 14 weeks, and it quite clearly shows that it's the tech sector that's leading the way, and pretty much everything else in the equity market is lagging behind. Now, there's a lot of concerns about market breadth. There's a lot of people saying breadth is so narrow, it means stocks must go lower. Go and back test it. There's very, very little correlation between narrow breadth and equities rolling over. So you could equally be long the S&P. In fact, if we do get any dips in the S&P 500, I'd be looking to buy those as well. The reason why I've chosen to go with the Nasdaq this week is twofold. One, it's tech leading the way, so let's go into the tech-heavy index. And the second is that we've broken above this resistance that I highlighted in blue there, and we're actually starting to get into quite a nice uptrend. There's 2 levels above where you could take profit off the table, and of course you've got the resistance turn support below where you would put your stop loss. But I like long tech at the moment, even if I can't spell in the caption that I've written for this slide. Ryan, what about the FTSE 100?
I was keeping sure about that because I saw it taking a charge E. I didn't know if that's a technical term there, but no, I don't know if that's your spelling mistake or Kyriakos, but I'll let you deal with that, seeing he's sitting 5 yards from you. My play of the day is the FTSE, and yeah, I'm looking for a break above 7,800. It's looking quite positive, and particularly even the Bank of England looking positive about the UK economy. And a lot of people in this country always write down the UK, investors, banks write down the UK. It's always glass half empty. Well, I'm a glass half full kind of guy. Well, if I've got anything in my glass, I'm a happy man.
Quarters empty.
3/4 empty. It would be. That's typical you. 3/4 empty. I'm surprised it's not smashed on the floor. Anyway, so I'm looking potentially for a break here. It's holding decent support. If we get above this 78.10 area, look for that confirmation again. Then I think we may be going to have a look at the highs. If the trade is going to go wonky, it's going to go wonky between 76.85 below there. As you can see on the chart, bit of support below there. Then we're not going to be doing that, and maybe we're going to form a bit of a range between that 78 and a bit further down, 77, something like that. But for me, yeah, I'm bullish for the moment.
Well, for the state of my pension, I hope you're right. Before I end up smashing my glass on the floor, that brings us to the end of another show. Ryan from Forex Flow Live and Forex Analytics, thank you very much for joining us as always. Our producer, Kyriakos, he is 5 yards away. Do you want to say hello? No. He's waving at me. He doesn't. He's camera shy. He doesn't want to be on camera, but he is here. Thank you to Kyriakos, as always, for producing this show. And thank you, as always, for watching as well. If you've enjoyed the show, drop a like on the video. Leave a comment as well. Let us know how you're trading the markets. And we will be back again this time next week. Thanks, as always, and goodbye for now.